Statutory prohibitions. Prohibitions on financial institutions. Legal restrictions under the AML-CFT law and AML-CFT decision. Under AML-CFT law Article 16.1 C and AML-CFT decision Articles 13.1, 14, 35.4 and 38, financial institutions, FIs, are subject to several prohibitions aimed at preventing money laundering and the financing of terrorism. These prohibitions are essential for maintaining the integrity of the financial system and ensuring compliance with anti-money laundering, AML, and combating the financing of terrorism, CFT, regulations. The key prohibitions are as follows. 1. Anonymous or fictitious accounts. Prohibition. FIs are prohibited from establishing or maintaining any customer or business relationship, conducting any financial or commercial transactions, or keeping any accounts under an anonymous or fictitious name, pseudonym, or number. Objective. This prohibition is designed to prevent the use of anonymous or misleading identities for financial transactions, which could be used to obscure the true nature of the activities and evade detection. 2. Inadequate risk-based customer due diligence, CDD. Prohibition. FIs are not allowed to establish or maintain a business relationship or execute any transactions if they are unable to complete adequate risk-based customer due diligence, CDD, measures concerning the customer. Objective. This restriction ensures that FIs cannot engage with customers or conduct transactions without thoroughly assessing and understanding the risks associated with them, thereby reducing the risk of facilitating illicit activities. 3. Dealing with shell banks. Prohibition. FIs are forbidden from dealing with shell banks. This includes not opening correspondent bank accounts in their names or accepting funds or deposits from shell banks. Objective. The prohibition against dealing with shell banks helps prevent the use of such entities, which may lack a physical presence and operational transparency, as conduits for illicit financial activities. 4. Refusal of reporting obligations. Prohibition. FIs cannot invoke banking, professional, or contractual secrecy as a pretext to refuse performing their statutory obligation to report suspicious activities. Objective. This prohibition ensures that confidentiality or secrecy claims are not used to avoid reporting suspicious transactions, thereby supporting transparency and the effective identification of potential criminal activities. 5. Bearer shares and bearer share warrants. Prohibition. FIs are barred from issuing or dealing in bearer shares or bearer share warrants. Objective. This restriction is intended to prevent the use of bearer shares and warrants, which can be easily transferred and may facilitate anonymous ownership and transactions, undermining the transparency of financial operations.